Hi, this is Jerry Barras, United Financial Planning Group. Just wanted to talk today a little bit about variable annuities with step-up guarantees. Pretty popular product being sold all over the country. Clients are attracted to these variable annuities because of the guarantees that are offered by the insurance companies. Unfortunately, I think the guarantee is in and of itself a little misleading and confusing. And most clients, when they do sign the contract, don't really understand the detail behind the actual product itself. Normally, when we meet with clients initially, some clients have the annuity itself, and when we review the contract with them, they realize that the actual investment itself wasn't what they expected. And 9 times out of 10, most of the products themselves have high costs and fees associated with them. So I'd like to jump into a real-life situation with a client we met with a couple of weeks ago, where we explained and went through and basically presented to him the details behind the annuity itself, and what decision he could make at this point in time to potentially cash out of this variable annuity product, and show him the differences in either annuitizing, holding on to the annuity, or cashing out with either creating his own annuity or just letting the money be invested in a normal brokerage account, and show him what the growth potential would be down the road. So sort of a comparison on various options. His initial investment when he first purchased this annuity was $300,000 in 2009, so 10 years ago. And his current cash surrender value 10 years later now is $441,562. So the growth was about 3.94%, just under 4%, which seems okay. But if this product itself, and most variable annuities allow you to select mutual funds that give you stock market exposure. And in his situation, he had a pretty large chunk of that money invested in stocks. So I would have expected this number to be much higher, considering over a 10-year period he's invested, I would say probably about 60% in equities. And I know what happened really is that the fees within the account just ate into the performance. This contract, basically, there was 2 pieces to it in terms of expenses. 1% was related to insurance, which was part of the guarantee, which I'll explain to you in a minute. And then it had about 1.25% in fees just related to the investments themselves. So about 2.2% average annual fees, which really probably ate into the performance, which is why that number is lower than it probably should be. So now 10 years later, fast forward, my client's 7 years old. And basically his cash surrender value, like I mentioned, was $441,562. And now the insurance company is saying, well, you have a guarantee of $590,000, just above, that we'll pay this out to you over a 20-year period. And how they determine this number, this guaranteed amount, is at some point during the 10-year period, his account value hit $590. All right, so it basically allows you to kind of lock in certain high points in the value of the account. And so what they're saying is, okay, based on that step up and that high point, we're going to guarantee this amount over a 20-year period, starting today, if you were to annuitize. Or if you want to, you could just take cash surrender and walk away. So what I'd like to do is just show you, basically the 4 different options on what the client can do in his particular situation. Option 1 would be just take the guarantee. The $590,000, if I divide that over a 20-year period, it's $29,507 per year for 20 years, and then there's nothing left. All right. If you decide you want to cash out, then you get the lower amount, which is $441,562. Now, if I follow that and say, okay, I'll take the $441,000, I'll invest it at, say, 5.5%, which is I would say, pretty conservative rate of returns, some stock market exposure, but probably pretty significant amount of fixed income. And I follow the same distribution amount. I'm going to take the exact same amount that they were proposing in the guarantee. But the only difference is I'm going to invest this amount in the markets at 5.5%. If I take that every single year, I'm going to end up with still almost $253,000 in the account at the end of a 20-year period. So that to me is a much better deal than annuitizing. All right. So now if I jump to, well, let's just say you want to leave the money in their account, not annuitize, not take their guarantee. And you would say that, okay, if you invested a similar way, 5.5%, subtracting the fees, so you're down to to almost 3.3%, you'd end up with about $843,640 in the account. Now, if I take the 441,562, and I invest that at 5.5%, but then I don't take any distributions and I don't have the fees for the annuity, basically just rolling the money into a brokerage account and investing it without any distribution, I'd have almost $1.3 million in the account. So as you can see, annuitizing or leaving the money in the annuity at this point really doesn't make any sense. You can do a lot better creating your own annuity, or just leaving the money in a brokerage account and investing it on your own. If you have any questions, please give us a call. We'd be happy to review your annuity, take a look at your contract, and come up with some options for you as well. Please visit our website or give us a call at the number below. Thank you.